Okay, so you want to own parking garages. Concrete boxes stacked 8, 10, 12 levels high. A gate arm at the entrance, a dumb little machine that spits out a ticket, and every single car that pulls and hands you money before it leaves. No inventory, no customer service line, no product that goes bad in the back room, just empty air, gated off, rented by the hour. Sounds like the laziest business model in existence, and in a strange way, it kind of is. But the reason parking garages are one of the highest margin real estate plays in American cities has almost nothing to do with parking. It has to do with what you're actually standing on top of, and that distinction is going to matter a lot more than you'd think by the end of this. Let's start with the obvious question. What does it actually cost to get into this business? You have to paths. Buy an existing garage or build one from the ground up. And the gap between those two numbers tells you almost everything about why this industry looks the way it does. Building a parking structure from scratch in a major city runs somewhere between $25,000 and $50,000 per parking space, depending on the market and how many levels you're going underground versus above it. A modest 500-space garage, the kind you'd find attached to a downtown office building, can cost $15 to $25 million to construct before it opens a single gate arm. Underground parking is dramatically more expensive than above-ground structures because you're now excavating, waterproofing, and reinforcing against soil pressure instead of just pouring concrete decks into open air. A single underground space in a dense city can run past $60,000 once you account for excavation and shoring. And that's before you've bought the land the garage sits on, which, in a downtown core, can be worth more than the structure itself. In the most expensive coastal cities, land alone can push the effective cost per space past $100,000 before a single beam goes up. Buying an existing garage is usually the cheaper entry point, but here's the trap that catches first-time buyers. The price you pay is rarely about the garage, it's about the zoning underneath it. A parking structure on a small, footprint downtown lot, one that happens to be zoned for a 40-story residential tower, can trade for a price that has almost nothing to do with how many cars park there every day. You're not really buying a parking business in that transaction. You're buying a development site that currently has cars on it instead of condos. Appraisers in this industry have a specific term for this. They call it the highest and best use value, and for a huge share of urban parking lots, the highest and best use in parking at all. It's whatever gets built there next. Keep that idea in your back pocket. It's going to come back later, because it's the entire secret of this industry. Most people picture parking garage ownership as a mom and pop business, a guy with a folding table and a cash box. That's true for a small slice of the market, mostly surface lots in smaller cities, but the real money in this industry runs through three very different ownership structures, and they behave nothing alike. The first is the private operator. Companies like SP Plus and Ace Parking manage thousands of facilities across the country. But here's the detail that surprises people. In most of these deals, the operator doesn't actually own the garage. They run it under a management contract for a flat fee or a lease arrangement where they pay the property owner a fixed rent and keep whatever they collect above it. That second structure is called a lease operating agreement, and it flips the risk entirely onto the operator. If revenue underperforms, the operator still owes the fixed lease payment to the landowner every single month. The real estate risk sits with whoever owns the concrete. The operational risk sits with the company running the gate arms. The second structure is the municipal parking authority. Cities build and own huge portfolios of public garages, often financed through municipal bonds, and either run them directly or contract the operations out to a private firm. This is where things get politically interesting because a city-owned garage isn't just a business, it's also a policy tool for managing downtown traffic and subsidizing retail districts, which means the pricing decisions aren't always driven by profit maximization the way a private owners would be. A city might deliberately underprice its garages to encourage people to shop downtown instead of at a suburban mall, even if that means leaving money on the table every single day. The third structure, and the one that quietly explains a huge amount of parking real estate in this country, is the long-term concession. This is where a private company doesn't buy the garage outright, but pays a city a massive upfront sum in exchange for the right to collect their revenue for decades, sometimes 75 or even 99 years. We're going to come back to this one because it's where one of the most controversial deals in modern American infrastructure happened, and it's worth understanding in detail. Before we get to revenue, there's a layer of costs that catches almost every new garage owner off guard, and it has nothing to do with rent or vacancy. It's the building itself. A parking structure is not like an office building or an apartment complex. It is a piece of concrete that sits exposed to the elements, gets driven on by thousands of tons of vehicles every week, and gets doused in road salt every winter in cold climates. That salt seeps into the concrete and corrodes the steel rebar holding the whole structure together. This isn't a cosmetic problem. It's a structural one. Garage owners are required to run regular structural inspections, typically every 1 to 3 years depending on the jurisdiction, and when corrosion is found, the repair bill is not small. Major rebar and concrete restoration work on an aging garage can run into the millions of dollars for a large structure, and if it's ignored, the consequences can be catastrophic. There have been multiple documented cases across the country of parking structures partially collapsing due to deferred maintenance, and when that happens, the liability exposure for the owner is enormous, both in terms of lawsuits and in terms of the criminal negligence questions that follow a structural failure involving public safety. Second, ADA compliance. Parking structures built before modern accessibility standards often need retrofitting, wider stalls, proper signage, accessible routes to elevators, and the cost of bringing an older structure up to code can run into the hundreds of thousands of dollars depending on the size of the facility. Third, insurance. A vertical concrete structure that the public drives through at speed, walks through at night, and parks thousands of vehicles in simultaneously is a significant liability exposure. Slip and fall claims, vehicle theft and break-ins, structural liability, all of it adds up to insurance premiums that are meaningfully higher than a comparable office building of the same value. Fourth, technology. Modern garages need license plate recognition systems, digital payment infrastructure, mobile app integration, and increasingly, EV charging stations, all of which require upfront capital and ongoing maintenance contracts. And fifth, something most new owners never budget for at all, cleaning and pressure washing. A parking structure accumulates oil stains, trash, and debris constantly, and a neglected garage doesn't just look bad, it actively drives away the monthly contract customers who are paying the premium rate for a clean, safe place to leave their car every day. None of this shows up in the simple mental picture of a gate arm and a cash box. It's the cost of keeping several thousand tons of concrete safe for public use every single day for decades. So, how does a parking garage actually make money? The answer has more layers than most people expect. The first and most obvious layer is transient parking. Hourly and daily rates paid by people who just need a spot for a few hours. In dense downtown markets, this can run anywhere from $15 to $40 a day, and in the most expensive cities during peak demand, daily rates can push past $60. The second layer, and often the more important one, financially, is monthly reserved parking. Commuters and downtown residents who need guaranteed access sign long-term contracts, often paying several $100s a month, and in the tightest markets like parts of Manhattan or downtown San Francisco, monthly rates can exceed $500 or even $600. This is the parking industry's version of a lease. It's predictable, recurring revenue that doesn't depend on daily foot traffic, and in a well-run garage, monthly contracts often make up the stable financial floor of the business, while transient parking is the variable upside layered on top. The third layer is event day surge pricing. A garage next to a stadium, arena, or concert venue can charge dramatically more on game days, sometimes 5 or 6 times the normal daily rate, because for those few hours, the supply of nearby parking is fixed and the demand spikes hard. A single well-located garage near a major venue can generate more revenue on 20 event days a year than it does across the rest of the calendar combined. This is exactly the same logic as the kiosk economics inside a shopping mall. Position beats size. A garage that happens to sit 3 blocks from an arena is worth dramatically more per space than an identical structure a mile away, purely because of what happens 20 or 30 nights a year. The fourth layer is ground floor retail. Many modern parking structures are built with commercial space along the street level, coffee shops, convenience stores, restaurants, because a blank concrete wall at street level kills foot traffic and looks dead to the surrounding neighborhood, and increasingly cities require it through zoning codes. That ground floor retail often generates rent income that has nothing to do with parking at all, and in some buildings, it can be one of the highest revenue per square foot uses in the entire structure, because that ground floor commercial space is priced like prime retail, not like a parking deck. The fifth layer, and the one that's growing fastest, is EV charging. Garage owners are increasingly installing charging stations and charging a premium for the electricity plus the convenience of a guaranteed spot, and in cities pushing hard on electric vehicle adoption, this has become a meaningful new income stream layered on top of the base parking fee. Some operators are now reporting that EV charging bays generate 2 to 3 times the revenue per space of a standard stall, because customers are willing to pay for both the electricity and the guaranteed convenience simultaneously. And then there's a sixth category that almost nobody thinks about, which is the one we mentioned earlier: air rights and future development value. In a growing downtown, the land under a parking garage is often worth more than the parking revenue it generates in a given year. Owners sometimes hold a garage specifically because it produces just enough income to cover the property taxes and carrying costs while the land appreciates, waiting for the day it makes more sense to demolish the garage and build a tower on top of it. This is sometimes called land banking, and it's a well-known strategy among sophisticated urban real estate investors. In that scenario, the parking operation ain't really the business. It's the placeholder. A surface lot or a modest garage sitting on a prime corner can be one of the most patient, quietly profitable investments in an entire city, not because of what it earns this year, but because of what it's allowed to become the year the owner decides to pull the trigger. Now here's the other side of the ledger, and it's where a lot of the apparent simplicity of this business falls apart. Property taxes on a downtown parking garage sitting on extremely valuable urban land can be enormous, because the land is assessed based on its underlying value and its zoning potential, not based on how many cars parked there that month. Security staffing has to run around the clock because an empty concrete structure at night is exactly the kind of place where crime happens if nobody's watching. Lighting alone for a large multi-level structure running 24 hours a day adds up to a significant utility bill every single month. Elevator and escalator maintenance contracts are mandatory and expensive because a broken elevator in an 8-story garage doesn't just annoy customers, it can violate accessibility requirements and expose the owner to legal liability. And structural inspections, the ones we talked about earlier, aren't optional. They're recurring, and when they turn up a problem, the repair bill doesn't wait for a convenient ear. None of these costs shrink when occupancy drops. The lights still run in an empty garage. The elevator still needs servicing whether 10 cars parked that day or 1,000. Property tax doesn't care if a recession kept people out of downtown offices. This is the exact same structural trap that runs through every asset this channel has covered. Fixed costs that don't move, sitting underneath revenue that absolutely does. To understand how badly this can go, we need to talk about one of the most controversial infrastructure deals in modern American history, and it involves parking meters, not garages, but it exposed exactly how this industry's economics actually work when a city sells away decades of future revenue for cash today. In late 2008, the city of Chicago, facing a significant budget shortfall, agreed to lease its entire parking meter system to a private investor group for 75 years in exchange for a lump sum payment of roughly $1.15 billion. The deal was approved by the city council in a matter of days, with almost no independent analysis of whether the price was fair. It later came out that the city's own Inspector General estimated the true value of that 75-year revenue stream at closer to $2 billion, meaning the city may have left close to $1 billion on the table. Within months, meter rates across the city jumped sharply. In some areas, rates roughly quadrupled over the following years, and residents who had never thought twice about parking meters suddenly found themselves paying dramatically more to park on their own streets, with the extra money flowing not to the city, but to a private investment consortium for the next 7 decades. The public backlash was severe. City officials who approved the deal faced years of criticism over it, and it became a national case study taught in public policy programs on how not to structure a long-term infrastructure concession. The city also agreed to compensate the private operator for meters taken out of service for construction or street closures, which meant even routine city maintenance work started generating unexpected bills back to the taxpayers. Here's the part that matters for anyone thinking about owning parking infrastructure. The investors who bought that concession didn't misjudge the value of parking. If anything, they judged it better than the city that sold it to them. They understood that a fixed supply of curb space in a growing downtown, protected by geography and impossible to replicate, was going to generate escalating revenue for decades, especially once rates were adjusted to match actual demand. The city, under fiscal pressure, prioritized cash today over the value of a scarce asset tomorrow, and that mismatch is exactly the trap that governs almost every long-term infrastructure concession in this country. Whoever understands the true long-run value of a scarce piece of urban land almost always wins the negotiation against whoever needs cash right now. That's the structural lesson sitting underneath the entire parking industry, whether we're talking about meters or garages. Parking assets are not really valued on this year's cash flow. They're valued on decades of captured scarcity in a location nobody can replicate. And the party that understands that math correctly is the party that ends up owning the upside. It's worth pointing out that this same dynamic plays out on a smaller scale. Every time a city sells or leases an individual garage rather than an entire meter system, municipal budgets are built around 1 and 2 year cycles. Parking assets generate value over 30 and 50-year horizons, almost every time those two timelines collide under fiscal pressure. The beer with the patient horizon comes out ahead of the seller who needed the money now. So does owning a parking garage actually work as a business? The honest answer, like almost everything on this channel, depends heavily on the year and the location. In the strong year scenario, you own a well-located downtown garage near an office district, a stadium, or a growing residential core. Monthly contract parking stays close to full, providing a stable income floor. Transient parking runs strong during the week from commuters and shoppers. A dozen or more event days a year at premium surge pricing add meaningful extra revenue on top of the base. Ground floor retail is fully leased. EV charging stalls are consistently occupied at a premium rate. Structural maintenance for the year comes in on budget, with no surprise rebar repairs. In that year, a well-run garage can produce operating margins that rival or exceed almost any other real estate asset class, because once the structure is built and the debt is serviced, the marginal cost of one more car parking for an hour is close to nothing. Industry data on stabilized urban garages regularly shows operating margins north of 50% once debt service is excluded, a figure that would be considered extraordinary in almost any other real estate category. In the bad year scenario, a major downtown employer shifts to remote work and monthly contract renewals drop sharply because the commuters who used to need a guaranteed spot 5 days a week simply aren't coming into the office anymore. Foot traffic for transient parking falls as retail and restaurant activity in the surrounding blocks softens. A structural inspection turns up corrosion that requires an unplanned 6-figure repair. Property taxes, assessed on the appreciating land value underneath the garage, keep climbing. Regardless of how many cars park that month, insurance premiums rise. Industry-wide following a liability claim somewhere in the sector. Security and utility costs stay fixed because the building still has to be lit, staffed, and maintained whether it's 40% full or 90% full. This is not a hypothetical scenario. It's close to exactly what happened to downtown parking operators across the country in 2020, when office occupancy collapsed almost overnight and monthly contract cancellations spiked while the fixed costs of running a multi-level concrete structure kept arriving every month regardless. Some operators saw revenue fall by more than half in a matter of weeks, while property taxes, debt service, and structural maintenance obligations stayed exactly where they were before anyone had ever heard the phrase remote work. Many downtown garages that had been reliably profitable for decades were suddenly running at a loss, not because anything about the building had changed, but because the office towers around them had emptied out and never fully refilled on the old 5-day schedule. The gap between those two scenarios, the strong year and the bad year, for the exact same building, can be the difference between a stable cash generating asset and one that's quietly bleeding money while still looking full enough from the sidewalk. Occupancy on a slow Tuesday afternoon doesn't tell you whether the monthly contract base underneath it has been quietly eroding for 2 years. And that's really the final thing to understand about this business. A parking garage looks like the simplest asset covered on this channel. No tenants to manage, no employees behind a counter most of the day, no complicated supply chain, just concrete, a gate arm, and cars coming and going. But underneath that simplicity is the same structural truth that runs through malls, airports, banks, ranches, and stadiums. The value was never really in the day-to-day operation. It was in the scarcity of the land, underneath it, in a location that can never be duplicated, protected by geography and zoning in a way that almost no other business enjoys. The garage isn't the business, it's the patient placeholder sitting on top of the actual asset, quietly collecting rent by the hour while it waits for the neighborhood around it to decide what that land is really worth.